Fenton.
Witten, happy Friday, my friend.
Happy Friday to you, brother. Mate, what is going on in the world? What are you drinking today? Welcome to Wealth, Wine and Wisdom, folks. I'm out and about. I'm up in Brisbane in a fancy hotel, and I've scratched around in the room, and I've got myself this is the type of wine I should drink, Fenton. It's a little mini bottle. It's a one glass. Well, looks like two glasses, but...
that looks like a small glass for a giant.
Yeah, well, it holds all right. See, I've put some product in the background here. I've placed some product over here.
Out of the mini bar. You've done a good job. You've done a good job. Like with limited resources, limited time, you've done an incredible job. I'm super happy. So you're up taking some time away from the week and enjoying big Bris Vegas, eh?
Mate, getting an early little mini break in with the fam. So tonight I'm away for 5 days. So should be fun, but up the road. But starting the little mini break off with a little glass of wine and a hang out with you, mate. And a big hello to Alison. There's a bunch of you guys on already now, so give us a shout out, folks. Let us know who's in the house. Great to see all of you guys joining us for another Wealth, Wine and Wisdom. But Andy, a good show ahead of us. But let's tell the folks who are joining us, do the intros of Wealth, Wine and Wisdom.
Well, mate, it's been a while since I've had the honours, but seeing as you're on holiday, mate, I may as well
sit back and relax, and you do your stuff.
You just sit back. I'll do the heavy lifting. So, welcome everybody. You can throw them up there, Marcus. It's good to see you here, mate. Welcome. Yes. We've got Anne here from Cairns. Anne. Geez, I'd love to be up where you are. I tell you what, it's freezing down here. And James, how are you guys going? Hopefully you're all well. We've got a crack-up show today. And what I'd say is any of you have got, whether it's your superannuation and you're with an industry fund or you've got, equity market or global market queries, start to get that hashtag Q ready for the chat because we've got something special in line for you guys and girls here today. Wealth, Wine and Wisdom. Myself, Andy Fenton, reformed investment banker from many, many years ago, now advisor to business owners around Australia, trying to teach them how to street fight and do it the right way. Jason, my counterpart in legal crime, the crime being how to minimise your tax, because apparently that's a crime. Just ask Kerry Packer. And Jace is 20 plus years in property. I was just saying to one of our guests that we're going to introduce you to later is that I don't know anybody more knowledgeable in property, but I missed out on the knowledgeable in understanding the street fighter tactics for business owners in order to be able to really navigate what is sometimes an incredibly brutal journey. And for those business owners out there, you know that it's your life, it's your blood, sweat and tears. And so not just an amazing mind when it comes to property, but an incredible business owner with some incredible skills. We've got Angela, who's just walking across the road to buy a Reds. Hopefully you're not watching us and walking. Make sure that you listen to the little...
Don't get in by a car, Angela.
Yeah, that's right. So Wealth, Wine and Wisdom, the little preamble, 3 years almost, where Jason and I came together to start helping business owners and investors navigate through COVID, because there was a lot of misinformation, a lot of information just flowing in all directions. And so we started to come together and decipher that. And then we decided to bring that to you guys live as we debrief the week. And that's effectively what it is still today. It's here for you. It's here for us to share our collective minds, sometimes some wisdom. In Jason's case, never take advice on what wine he's drinking, ever. It's just not a good idea.
Yeah, I'm not the one who knows what's going on with that. Fenton's got much better taste. Well, something's happened in my room here, Fenton. So you keep going. I think maybe my room's turned into set the mood scene or something. It just
maybe there's a little bit of a surprise that's waiting for Jason in the room a little bit. This, ladies and gentlemen, could actually get quite interesting. We'll see what's in store for Jason as the lights go down and the music turns up.
You keep talking.
But so ultimately, this is our space where we get to debrief the week with you. So what we're going to share with you tonight, with a special guest as well, which is a good friend of mine, and some not old as in years, but we've known each other for quite some time, who's going to share some incredible insights. A very, very sharp mind of all things investing. Own business, who's now well over $1 billion of funds under management. So get the hashtag Q ready for questions as we introduce Dan. But perhaps before we do, mate, as a little bit of an introduction to Dan, and also what we've been seeing in the news, might jump across to what's in the news. Because, ladies and gentlemen, what we do here is we have a little bit of a look-see, because what tends to happen in the news, shocked and chagrined, I know, they have a tendency to over-exaggerate, and they have a tendency to be full of shit. And,
no.
So one of our goals here is to try and help everybody just navigate some of that. And so what I thought was a great introduction, because Dan will talk about price and value and asset classes and what's good to have and what potentially you should be avoiding and all of these various different things. But most of us don't make investment decisions or even decisions based on that. We make a lot of it based on this. So AMC is actually a gaming stock, and I love this because ultimately this is a headline from the Financial Review. I'll read it verbatim so I don't get it wrong. Let them come. Cliff Essens told meme traders. So Cliff told the meme traders after revealing he was shorting their favorite stock, AMC. There's the dyslexia coming out. And they did. And ultimately, I thought this is a great discussion point, because we've talked about meme stocks before, Jace, and meme stocks are effectively those stocks that end up with cult followings. Tesla was basically one, although Tesla had a lot of substance. AMC is definitely one. Then we had, you could almost, they were meme coins as well. So Dogecoin, right? So basically a Saturday Night Live appearance by Elon Musk, where he took the piss out of Dogecoin and it fell through the floor. Right, so these meme stocks are these things that gain a huge amount of momentum, where the taxi driver tells you should be in AMC, and but ultimately, mate, what ended up happening is a quant manager unleashed revenge against these guys, because quant is the exact opposite to emotional trading. So meme stocks are emotion. We love it. We love the people behind it. We don't care what it's made off of. We just want more of it. But quant is the exact opposite. It's what are the numbers? What's the reality? What's actually going on behind the scenes? Is this company going to be around with 1 million supporters but zero in the cash? And
when you say quant, Vinton, is that company or is that a style of analyzing an investment?
Great question.
Yeah.
Well, quant, technical term, quantitative. So it's looking only at the numbers. So when you talk about a quant manager is what we refer to in the industry as a black box sometimes, but ultimately they're just making decisions based off numerical data. They're not looking at the art. They're looking more so at the science and the maths behind it. So an example might be there's a type of black box trader, which is an investment management technique, which is called momentum trading, right? And that means that when something in the market gains a lot of momentum and more people are buying, and it goes up, and more people are buying and going up, kind of like Tesla back 2 or 3 years ago when where I think I said buy when I probably shouldn't have, but you should have bought, right? When that started trading, it created a lot of momentum, more and more people buying in. So a momentum manager will pick up on that amount of influx of funds into that stock, and they will start to actually ride that momentum, ride that wave. So it's purely analytical based. It's purely based on quantitative data. Yeah. Right. It doesn't care if Elon is the CEO. It doesn't care if it's the darling buds of May. It makes decisions based off the numbers. So there's a little bit of a war between the quant world, so the numbers world, and the meme stock world. And this will be an interesting one to play out. So anybody who wants to see who wins this stoush, just Google AMC. Don't invest in it. I don't think it's a great idea. But have a look at what's going to come on this, because it's ultimately when generally when the numbers guys actually start to back this stuff, they're generally right, and we'll see how it ends up. But mate, I thought I'd throw this one over your side of the equation because I read this. Well, Jason's definitely going to have something to say about this, and I'm going to read it verbatim, mate, and I'll throw it over to you. It says suburbs that post the biggest gains during the pandemic are losing the most value, but others are beginning to drop as well. So ultimately, a pessimistic article. It says highest rising post codes during COVID are the fastest falling. Mate, is this true? Is there any truth to this? What's the reality behind it?
Well, Fenton, as we all know, in misdirection and lies and misinformation, a small amount of truth mixed in with a lot of bullshit actually gives some things validity, right? So right now, if you're talking about this, is it true? And technically right now, when we analyze the actual property market, the answer is yes. The most expensive property market or segment in the property market in the residential world is at this moment in time falling the fastest, right? So in and of itself, it's a true comment, but does it paint the same picture? No, it's absolute bullshit, because the previous 3 years, that segment's gone up between 30 and 50% in some places. And we're now talking about a 2% decline, right?
Wow.
Like, so let's put it in perspective. Andy, you and I like these things about collecting dots and connecting dots, right? So the headline is accurate, but, in the scheme of things, if your property's up 30% and it course corrects 2%, you're not crying in your soup about it. But the media is dining out on the headline, right? So really, at the end of the day, like even when you were talking about, the quantitative investing, it's about the data, it's about the information.
That's it.
And finding out, compared to what, the process of seeing the info and comparing it to timeframes, comparing it to different market segments, et cetera, et cetera. It's interesting. It's really interesting right now. Some of those, yeah, we love this one. Some of those things right now, if you're looking at the same research, because I read the same data, the same research paper, it's saying that the cheapest stuff, the crappiest markets are actually holding their own, right? So the cheapest rubbish stock, the worst demographic for, overall wealth for real estate is holding its own. Yeah, and, it doesn't take Einstein to work out, Andy, that the cheapest thing at the bottom of the market is always appealing to the majority of the buyers. All right. So it doesn't fall as much as something where, that people are paying $3 and $4 million for. So at the end of the day, it's an accurate comment in isolation, but not accurate in totality when it comes to the marketplace. So yeah, it's there again. It's that clickbaiting that's going on. And for most people, let's face it, if you're up, if you're up 30% and it comes off even 10%, you're still 20% up. Who cares? At the end of the day, that's what happens. It's a very normal thing. Markets overshoot. The real estate market has overshot by a good percentage, and it's adjusting now because its cost base, which is usually driven by interest rate price, is now adjusting, upwards rather than downwards. So yeah, it's there.
Well, mate, because my line of thinking, and maybe this is a good way, segue to kind of introduce Dan in a few moments. And
Alison,
yeah, 100%, Alison. Yeah, they'll never ruin a good headline ever. Well, that's clickbait journalism, ladies and gentlemen. That's what it's all about, and that's, I guess, what we're here to help you out with, because ultimately you can gather data. And you can gather all of the dots up the far left-hand side, and then you can start to turn them into information, which means you sort the data into something that is meaningful. And then you've got to test your bias on that information, because most of us want confirmation bias. We want to believe that we're right all of the time. And the problem is that if you look for it, whatever you look for, you're going to see. And if you're looking for a conspiracy theory, well, clearly this is a unicorn that you're looking at. But ultimately, mate, one of the things that pings into my analytical brain when I start to see headlines like we just did is I'd go, well, somebody who has bought a high-end house, like, well, let's say Chris Hemsworth, I heard that he sold his pad up in Byron Bay. I'm not sure whether it was at a profit or a loss, but ultimately that sort of a transaction for him is not a large amount of money. And if people are buying lifestyle properties in the multiple of millions, and they go off actually transacting that property, when I think about it, just from a if it were me basis, I go, well, yeah, if it made sense, well, I don't want to have that anymore because COVID's gone and I don't need the double place, whatever the case may be. But then if you have a look at other areas, people are going, well, I will never sell until I'm kicked out onto the streets. And that's got to skew the property data.
Yeah, and the other thing that skews the property data is extremes in that property data. And maybe I've never asked you this question, Andy, so it's probably an interesting one, and maybe even Dan could talk about it later on. When you get extremes in pricing in a suburb, it skews the data. So the difference between the data for property stats between the median house price and the average house price. Now, the media likes to dine out on the differences on those two, right? So, the median house price and the average house price, the median, removes extremes, and then the average, bundles it all together. Okay.
Well, it's like what we were talking about last week with core inflation versus headline inflation.
Yes. Yeah. And, the average person, we don't get taught that stuff at school. Like, you don't get to hang on, did they say median or did they say average? And you're like, oh, fuck, I don't know. It's like,
sine cos tan. Oh shit, no, that's geometry.
Yeah, what? Yeah. And so, no wonder a lot of people get bamboozled and confused. That's part of your and my passion, mate, to, communicate that to people to really sort of increase their acumen when it comes to analyzing this stuff, because we do give away a lot of power and like an unwritten ground rule that, the Fin Review, because they're a reputational newspaper, reports only accurate things, or, an accountant is always right. Like it's these kind of things that we go, yeah, and it's not right. So, it's
an
good.
assumed truism, but in the actual fact that it could, in some cases, couldn't be further from the truth. And we believe that the sources that we're taking information from are right, because that's the way that we always have. Your accountant does your tax and they'll keep you safe.
Yeah.
The Fin Review is a financial newspaper, and it will report the facts. And it has done for many years, but Jesus, it's getting a bit loose. Actually, mate, you may or may not have seen a couple of your comments, because I go through it and I've got it on my iPad. I'm thinking about getting rid of the subscription now, but every now and again I see Witten's actual comments. You're better than this. Don't print this trash. And I'm like,
come on, Fin Review, you're better than this. Gee, crikey, But I think that's you're talking about that sort of this bias, this cognitive bias. And that's probably a good segue to sort of introduce our guest for today, Andy. It's really, this idea that, property is better than shares, that's better than business. Like, none of that is true in any way, shape or form. They're all great for whatever you're looking to achieve. And to be honest, I think, if you want a absolutely rock solid, wealth foundation, you should have an understanding of multiple pieces of the puzzle and understand which bit's going to suit you for what reason. And, and that's one of the things I'm very grateful for you, mate, because over the last sort of 5 or 6 years, we've known each other, and dive deep. You've helped me understand and educate a lot more because I was, fairly one-eyed when it came to the real estate world, and did my 10,000 hours in that industry. But I'm very grateful to see a lot of similarities in the other space. So why don't we dive in and get our guest in the mix, mate?
100%. Well, mate, it's a good segue because asset classes, it's not one's better than the other. It's sometimes how you combine them, and a lot of people out there believe that they can pick the unicorn that sits there, but most of them are full of shit. And so we're going to bring in Dan in a moment. Dan from Nova. He's a good mate and an old friend, not old by age, but old age-wise. He's been in my life for a little while, and we were talking just off screen a little while ago about a fund that he was thinking about launching called Rogue. And that
Renegade.
Actually, a Renegade.
Oh,
Renegade. I beg your pardon. Well, actually, both are quite. Rogue's probably not the right. But Dan manages an incredibly successful fund called Innova, or it's not a fund; it's actually a series of investments and managed accounts. And mate, we've known each other for a while now, and the fund has ticked over its 10-year earnings, which is an incredible landmark. And that's been ahead of most of the lads that I'm looking at in town that are some of the really big names on a global basis. So, mate, really happy for you to come in and share a little bit of your wisdom with us. Mate, I'll throw it over the fence. Did Jason and I fuck any of the points up earlier on? Did we say anything that wasn't quite true? Because maybe we should get rid of the elephants first.
No, the only thing I'd correct is, Jason, if something goes up by 30%, then down by 10, you're up by 17, not 20.
Oh, that's very interesting.
Compounding works, right? So if you lose 50% of something, you need to get 100% to get it back, right? If you lose 25, you need 33 to make it back. That's the non-linear profile in which compounding works. So other than that, though, I mean, as you and I have discussed, Andy, one of the key philosophies we've got is that the price you pay is ultimately the biggest driver of what you're going to get in terms of return. And you've just articulated that, Jason, that really high quality, great properties. Well, if you kind of overpay for them, if you pay too much for them, well, you've got to expect some level of volatility. Like if you're going to pay a whole lot for them, like they're worth an amount. Yep. If I think of it on a chart and say, well, this is how much it's worth and this is the price, the closer you are to there, well, then the less return you're going to get because you bought it up here, not down here.
Yeah.
It's not rocket science, right?
No, and it's not. And often, often I think people think it might be too. And it's nice to sort of, simplify it as much as possible because, certainly in your game and certainly in the real estate game, there can be a lot of people trying to make it more complicated so they can be impressive rather than actually, get a result for their clients, right?
Yeah, there's a lot of that goes on. A hell of a lot. And that's often quite why those black boxes are black boxes. They don't want people to realize how simple it actually is.
Yeah. Well, mate, why don't we kick it off, mate? And really, off air, we chatted just a little bit about, you and your philosophy, managing over $1 billion or helping people invest over $1 billion, over many years. But you specialize in the conversation around sort of, asset classes or styles of assets rather than direct, asset investing or direct investments. Can you give us like a 5-minute conversation about, what that means to sort of someone on the street, someone listening in right now potentially, and then, how you came about that version of the world for investing for you and your clients?
Yeah, well, at the end of the day, as Andy mentioned earlier, we think things should be evidence driven, right? They should be driven by the facts.
Yeah.
And the fact of the matter is that the asset class you invest in, whether you're invested or not invested, is always going to have a much bigger influence on your end result, as opposed to, which particular stock in the stock market you've picked, or which particular bonds you've held, or whether you've got a particular property. The decision as to whether you're going to invest in them at all and the amount that you're going to be doing it is going to have a far greater influence on not only your end result, but the path in which you follow to get there.
Yeah.
Right. And so that's why we've built our business. It's predominantly quantitative, actually. As Andy talked about Cliff Asness, he's actually a pretty famous guy. He founded AQR.
I think I butchered his name when I commented on it earlier.
Yeah, that's okay.
The right way.
I just coincidentally know his stuff because anyway. So we do a lot of what we do is very systematic, so very data driven, as you kind of highlighted, but recognizing that no model is perfect, and it never can be perfect, and so therefore we've got some very experienced professionals inside the team who will provide input and some oversight, and I describe it as the quantitative component is like a compass that tells you which direction you want to go, but the subjective component, the professionalism, tells you what mode of transport is the most appropriate way to get there.
Right. So kind of summarizing it, it's kind of like, well, so let's talk about some thematic things at the moment. So that they talk about Australia being very much commodity driven through some of its success at the moment. So and let's talk about renewables as well. And you kind of go, well, there are two themes, and you can either choose to pick, let's back commodities and renewables, or you can choose to go, BHP is going to do better than Woodside, or it's going to do better than the next player in town. So basically, what you're saying is you look at the part of the system that's going to move more so than the actual underlying within that system who are going to be the movers and shakers.
Yeah, correct. Because we can invest in just about any market anywhere in the world. We can make money off currency. We can make money off all the different plethora of bonds that you can invest in. At various equity markets, as I mentioned to you previously, Andy, we've had exposures to Europe that we got out. We've got exposures to the FTSE 100, which has been a fantastic place to invest.
Well, let's talk to that, because sometimes, when I'm sitting in my seat, sometimes the things that I look at, I go, they're so obvious. But when I sit in my seat, I don't have the capacity to move that quickly. And so what I kind of look from our managers is that the people who are managing the funds, that they move quickly, right? And that they make the decisions. But sometimes there's these big bloody signs, and Jason and I talk about them all the time. You can see it a mile away, but at our level, we can't transact to be able to move everybody's money so quickly, because there's a whole lot of stuff that happens behind the scenes. But you can see it a mile away. And so Europe was one of those things for you not too long ago, by the sounds of things. So
can I ask a quick reverse up question before we dive into that? For 30 seconds, Dan, asset classes, can you give us, high level, medium level, whatever? Is there 3? Is there 5? Is there 60? Is there do you know what I mean? Because in my world, it's like it's real estate, and it's real estate, but it's like commercial, industrial, and whatever. But just for a little context.
Yeah, no, that's a good point. And in fact, depending on what, I can go down to very granular levels, and then it opens up the number can be massive. But so if you start at the top, you start at the really big things, which are equity markets, what I call debt markets, but the industry calls it fixed interest, which I think is a bit of a misnomer. But debt markets, property, infrastructure, and cash. And then within equities, you've got different geographies, different sectors, different styles. Same thing with fixed income. You've got floating rate, you've got fixed, you've got corporate bonds versus government bonds versus loans, like all of these sub-asset classes.
Yeah.
And in fact, it's the analysis of those sub-asset classes and what it is that's driving the risk in those that we've added the most value to clients.
Yeah.
Because really, Europe's an example I could talk about.
That's perfect.
Energy, I could talk about silver bullion, but a really simple one is everyone's talking about inflation, right? So we were publishing about I think it was in February 2021. I said, look, the market's kind of pricing in a zero probability that inflation's ever going to be anything higher than 1% to 2%. And whilst I can't model inflation, I don't pretend to. In fact, I don't think anyone in the world can.
Yeah.
I know the probability of it not getting above that isn't zero. So therefore, I should do something about that in clients' portfolios. So that's what we did. We reduced the interest rate sensitivity. So if we go into a rate hiking cycle, those assets are not. So within the debt markets, we massively reduced what are called fixed rates bonds, which are the ones that get as rates go up, the price goes down,
Yeah.
and increase the ones that are called floating rate, which means they're linked to, the rates themselves. They're floating. They float with the rates.
And is that 3 and 10 and 30-year bonds, or is it like a different version of the world? Andy's been schooling me a little bit on it.
Yeah, so anywhere from 30 days out to 30 years.
Wow. Okay. Yep.
And it's kind of the reverse, Jace, of short, like a fixed term loans. You can get a fixed term 1 year, a fixed term 2 year, 3 year, 5 year, 10 year. Apparently, you said you can get a fixed year 30 year from someone. Which is crazy, right? But the equity markets kind of in this cycle work the opposite way, in that right now you want to be variable, right? Because as interest rates go up, you want to be able to get more and more interest as the interest rates go up. Whereas fixed means you lock your money in like a fixed rate loan, and you lock it in at 2% for 2 years, and then interest rates go up to 3%. Well, you've missed out on something, and that's effectively what Dan's talking about.
Yeah, and also when inflation's higher, the value of $1 next year is not worth as much, because it's, it doesn't buy as much, right? So that's why locking it in, you're giving stuff up. Not only could you, if you hadn't locked it in, could you reinvest it at a higher rate, but the amount you're getting is worth less.
Yeah. And, Andy and I talk about this all the time. I do it to, stir up a little bit of emotion in our clients. But we have a little saying called cash is trash, Dan. Like, it's just like, if you're sitting on cash, it's devaluing, and
it's a guaranteed negative return.
Yeah. I said that this morning, actually. Were you listening to my bloody Wealth Coffee Chat?
I published it a while ago and did a presentation on it. Sounds like, there you go.
Yeah. Yeah. It's
confirmation bias, Andy.
Yeah. Well, but our broad philosophy is money is best when it's circulating, and the idea is that you want it to circulate like a topography sort of on landscape. You want it to circulate to that point of balance. And if you can be one of the faster moving streams in there, unless you're a stream.
That's a great comment.
Usually I'd expect that from Jeff Allison, but good work, tonight.
So it's a matter about getting there first. So part of what you sort of do, Dan, is start to look at, okay, where's the water flowing next? Like, where's that next low point? Not necessarily on a stock basis, but in markets. And so you went through an exercise recently in Europe. Like, what gave you the signs? Because this might help us understand, in the future, where things, or how to look. But what were you looking at before you made the call on Europe? Because it was a pretty aggressive call, and it was a successful call, but not many people kind of made it. What made you go, okay, this is where we need to be? And then what made you sort of start to get out?
Okay, I'll try and not be too technical, but equity markets, if you want to make it simple, you can break it down into the return from the underlying companies. That's why you own them, because they generate a profit that you'll benefit from at some point in the future. Dividends, and how much those profits can grow throughout time. And so Europe in 2021 to us looked reasonably attractive, not only from that earnings growth component, but the amount you were paying for it. Because remember at the start I said the amount you pay is going to be key to what you're going to get as an end result. So what we refer to as valuation, and there's a number of different ways you can calculate that. But coming into February, there was one analyst, my co-founder, Dinya Irani in particular, said, look, the market, we've got some good gains on this. Things have done really well. However, whilst everybody's saying that Putin's unlikely to invade Russia, that's not in the price. Whereas in the UK, which was another European, it was like a European exposure, but that market itself was substantially cheaper with higher quality of earnings. And we thought that, well, look, at the outside probability that there is an invasion of the Ukraine, this is going to be a more secure place to have capital. And turns out it was. It turns out it was a good call. But some of that's luck. But there was a process behind it, and there was a system behind it. But yeah.
You know what? Brexit was one that caught me out with my pants down a little bit in a similar sort of a scenario, because I thought there was no way in the world that that Brexit was going to happen. But sometimes, so you're going from a price perspective because nobody had priced it into the market. It was actually it was a very healthy, let's not say bet, but it was a very healthy position to take, because it was so contrary to everybody else that was out there that if it actually came off, it was going to make a big difference.
Yeah, we did. Do you remember in COVID when oil prices on the technical component went negative in the futures? Anyway, we bought.
So just so everybody knows what Dan's talking about is when it went negative in the futures, this is literally when oil companies were paying. They were literally paying people to hold tankers of oil. They were literally like, they were going, Witten, how much space have you got in your backyard? Because we've got a big tanker of oil, which we want to put there, and you can have it. We don't want anything for it. You can have it and then do what you will with it. And literally, this was an incredible kind of movement that I don't think we'd really seen. I don't think I'd ever seen before.
Never
seen before.
No, never. And so we looked at it and said, look, we can't forecast where the oil price is going to go, but we know that even the Saudis can't produce it at much less than $20, and it's currently zero. So what's the market priced it in as? Like for the companies, the underlying companies, are they priced oil in at $15? Well, we know at $15, that means every oil refinery in the world will be shut down. So that doesn't make any sense. So is it going to 40, 60, 100? I don't know. But I know it's not going to stay at zero. So we allocated to it. We thought that'd be in the portfolios for 3-4 years. It was there for 5 months and snapped back massively. We went, all right, out. And in fact, we had a few clients say, why'd you get out so early? You got out when oil got to $60. We're like, well, because we don't know if it's going higher or lower. I can't predict that, but I can tell you it's not going to be less than the cost of production, because otherwise you just shut the wells off.
Yeah. And so this is something that, and mate, this is the reason I think that you and I started to get along so well back when we first met, is because Jason and I were talking about this when it happened, because literally when oil prices went there, I was telling everyone on Wine Wisdom, like, literally they're paying to store it. It's like it's like negative interest rates. It's like the bank is actually getting money from you to store your money there. And you kind of go, hang on, what? Like, this doesn't make, they're literally going, take the oil. We can't, we just need it gone. Do whatever you want with it. You know, give it to your mates. We don't care. You know, have a big oil party, whatever the case may be. And I was like, Jace, this isn't going to continue. It's not like all of a sudden oil is just going to stockpile in Texas, and then Texas is going to become the black state because it's just covered in oil. Like, this wasn't going to happen.
Yeah, correct.
So, you know, when I think, and this is what I think that most investors out there actually think as well. Like, when people put their money into super funds, and when people put their money, you know, into portfolio managers or with advisors and things out there, and me as an advisor for quite a few years thought that fund managers, that's what they do. They going to go, yeah, that makes sense. Let's get in. Like, why doesn't en masse? Why doesn't that seem to happen?
For people to protect their careers, it's fine to be wrong as long as you're wrong with everyone else, but it doesn't work out if you're wrong and no one else is there with you.
Yeah.
So it's more career management rather than looking after the end client. And you see that is just so ingrained in the industry. I just cannot tell you how it's. Yeah, people look after their careers before they look after their clients. And yeah, if you're wrong along with everyone else, no one will crucify you for it. But if you're willing to go and take a bet, you're willing to make an active position, which is what you get paid to do, by the way. Yeah. And you're proven wrong, well, that's a pretty lonely place to be. But we found that most clients, as long as you get more wrong than right, like, you're not going to get everything right. But they don't actually expect you to get everything right. They want you to get more wrong than right. When you get it right, you've got a greater magnitude as well. And so that's what we seem to have been able to consistently do, thankfully, for a decade now.
Yeah. And Andy was sort of telling me about, you know, some of those decisions you guys have made over time, you know, and obviously, you know, you don't get $1 billion to invest on behalf of, you know, I'm sure pretty wealthy individuals without sort of, earning it. Maybe we can sort of change gears for 30 seconds and talk about, the philosophy about that sort of stuff, Dan. When wealthy people come to you, or, it doesn't have to be wealthy people, but someone with money says, hey, I want my money to work for me. What are they expecting? What's your mandate? Like, what do you say to someone? I'm going to take your money, but here's what you can expect.
Yeah, there's actually two things. So predominantly when people come to you, I describe it as relative return on the way up and absolute return on the way down. Now that sounds like some jargon, but what it means is that when clients come to you in a bull market, when things are going well, they want you to do better than the market. And then the absolute part is, but if it goes down, I don't want you to lose anything. You're like, oh, okay, well, you might find that the only people who have done that in the past are Ponzi schemes like Bernie Madoff. But anyway, so what our philosophy is that the behavioral element, as we were kind of mentioning earlier before the podcast, before the video started, the behavioral element is visceral to people, and understanding how much risk they can tolerate. Yes. Really, like how much they can actually see. And I'm talking about stuff like there's a lot of people out there that say, unless you've realized the losses, they don't count. I'm like, well, yeah, hang on. If you've got a loss on paper, if you've invested in an asset and the loss is of a magnitude that a client can't tolerate, they're likely to pull it out. And if they do that, it derails all the strategy. It derails everything that is involved in wealth creation throughout time, because what you told them was you're going to get this amount of risk, and what they got was that much.
Yeah.
So our philosophy is about, let's be very strict and very clear on what the potential risks are and what the maximum levels of risk are that we'll take, and we will try to maximize the level of return without breaching it.
Yeah.
And that way, clients can stay a lot more comfortable with their investments, because unless we breach what's on the sticker label, we're still doing our job.
Yeah. Yeah.
So that seems to have resonated pretty heavily, which is how we got that money through the door. So, yeah.
And Andy, I've chatted about this, and, waxing a bit of lyrical and maybe soapboxing, as I said, as we sort of chatted off air, soapboxes are welcome here at, Wealth, Wine and Wisdom. But, the industry of, certainly financial planning, and I'm not that experienced in the world of, your world in the investment management, but, the financial planning is so heavily regulated and really just red tape. And it's actually quite sad that, there's a stat saying that, 100,000 less Australians in 2022 now seek financial advice because of all the regulatory issues, and financial planners have left, that industry in droves because of the risk associated with helping someone organize their financial well-being. So, that challenge you have to balance the client's outcome, but also be, realistic and be able to chase the return, but also, not be, hung, drawn and quartered by, something that would be a normal, risk to take. It's ludicrous that the industry is in such, I don't know, fucking disarray, to be honest, in that sort of space where the balance for you as a financial planner is just, is ludicrous for the behavior, so.
Well, me as a financial planner and Dan as the investment manager. But this is almost the oxymoron, and it's a nexus which people just don't understand. And because you actually think that, and I think Dan said it earlier on, and this goes to the media. It's almost the polar opposite to the media, is that nowadays it's about job and bonuses, and I think that one of us might have said it earlier on. I won't tell who it was, but investment managers, their value is based off their bank account, their individual bank account, not based on their performance. And what ends up happening in a world, and you, Jace, you and I, we want to stand out. We want to stand out giving the right sort of tips or giving the right information. We don't want to stand out for creating sensationalist headlines. But it's like the world of funds management seems to have gone the opposite direction, in that Now, everybody is too scared to wander too far away from the index, and the index is the global market, or the ASX, which is the whole Australian market. They're too afraid from standing too far apart from it, because as soon as you're apart, then all of a sudden there's a big light on you. And if you get it wrong, then the media beat the living bejesus out of you, even if it was the right decision to make, but just a little bit of wrong timing. And and something which I could illustrate from my experience is that we had a couple of people who brought a reasonably large amount of cash in just before COVID hit, and when the market was falling, it just dropped over 2 weeks. The market just got decimated. It was like, and you and I, Jace, we were at a function together, and we were filming stuff the night before to launch in the morning. And by the time the morning came, the market had dropped that much that it was obsolete. And we were like, this, you've got to get in. And they're like, you crazy? This is the worst time you could ever possibly get in. The whole world is going to blow up. And we had a fairly equal side of the 50% that said, okay, yeah, which is the disaster scenario, Jace, that you and I talk about, is like, well, if the world is really going to cash where we're going to be trading gold, well, the reality is that if there's a massive nuclear war and the whole thing's wiped out off the face of the planet, well, people are going to be going for food, cans of baked beans, probably bullets in guns, and things like that. The last thing they're going to want to fight over is gold. So there's this disconnect of rationale, if that kind of makes sense in an esoteric way. But it's a matter of being able to stand out enough or make those calls like you did at the beginning of COVID, and kind of go, well, this is what we believe based on the data.
Yeah.
You know, there's not enough people and there's not enough places. Therefore, all other things being equal, property prices should go up. Dan's kind of alluded to it with Europe and oil. It's like, well, oil companies cannot give you money to take the oil away from them for the next 10 years. It's just not going to happen. At some point in time, they're going to ask for some money back to buy that oil. And to make those decisions, it sounds commonsensical, but for whatever reason, it doesn't happen on a common basis.
Yeah, I mean, the conversation, I think, when people are trying to make sense of things, the fear and the sensationalism of where they get good information. Well, not good information, but information from, really taints that, Andy and Dan. Do you get, it's really interesting. Like Andy talked about sort of me starting from the bottom up. Like, I've got sort of the Aussie battler clients and customers, which I love. Like, that's kind of where I grew up, and like I grew up with nothing and created something. And in the scheme of things, it's not much, but still something that I'm happy with. But like what I've experienced is, like, no matter whether you've got a lot or a little, still the media has some effect on your psychology, emotionally or mentally, when it comes to investing, right? Do you get clients calling you and say, I read the newspaper and I want out? Like, do you know what I mean? I read the headlines. Or is that different at sort of different levels for you?
For me or for Andy?
For you, I think, like, it's like,
Yeah.
Sort of, yeah.
I have experienced it in the past, where, particularly in the GFC, that's when people were calling all the time, panicking.
Yeah.
This time around, it's actually been, the sell-off for the first 6 months of this year was actually reasonably orderly, as the fundamental information in regards to inflation and global economies was deteriorating. Prices were going down, and prices were going down in those assets that were more richly priced than the ones that were cheaper. And so, to me, I was saying to my team, a lot of people are saying this is pandemonium, but honestly, this is probably the most rational the market's been in a long time, because things are deteriorating, and so stuff is worth less, or you should pay less than what you were prepared to pay a year ago. I've spoken to a number of advisors now, and I'm like, how many calls are you getting? They're like, not really any, because the other half of an investment manager's job, Andy, I think, is communication. Is actually telling people what it is you're doing, why you're doing it. Yep. And so if clients know what you're doing and why you're doing it, and they can understand it, they know you're not going to get everything right. But as you pointed out, you might have been for all the right reasons, but you just can't get everything right. That's why you probability weight your position sizes and you diversify across different assets. At certain points in time, the potential upside is not very high, and the level of uncertainty is high. At those points in time, diversify more, have more stuff.
Yeah.
And there's a mathematical way you can do it, but we won't go through it. But if anyone's interested, just Google something called the Kelly criterion. Anyway,
we're going to get questions on that next week, aren't we? I better brush up on the Kelly criterion.
The guy who invented card counting, Ed Thorpe, was one of the best hedge fund managers of all time. He used the Kelly criterion in his position sizing. But in layman's terms, it's if the potential upside's low, the uncertainty's high, then spread your bets. Yeah. But if you can find some things that you've got a high level of confidence in with a lot of potential upside, there's no point in spreading your bets. Start to combine them together. You might want some hedges in place just in case you're wrong, because no one's ever right all the time, but you don't need to have as much spread. Does that make sense?
Yeah, that does make sense. I think that's great. And, as we, having this conversation, I'm thinking, with your exposure to, good information and, lots of different things, different machinations around the world economically, 1 to 5, things to keep an eye on for, Australian investors, like, in share investors, property investors, business owners, listening in, just say, hey, what's on the sort of the amber light watch list for Dan, when it comes to Australians?
At the moment, we quite like looking at, floating rate bonds, and there's a few ETFs that you can buy to get access to them. They've gone from yielding, you can buy stuff that, if you've ever heard of credit ratings, they start at AAA and then they get down to triple B, and then below triple B into the C's is where you get sub-investment grade or junk bonds. In that investment grade space, it looks like it's priced in probably a 50% chance of global recession. Whereas if you look at the high yield space, the sub-investment grade junk bond space, it's probably about a 20-odd% chance of recession. And some of the stuff I've seen in the news is that they've said, equities have priced in a X% chance of recession, If I look at just broad equity indices and use a series of valuation metrics on them compared to their own history, the equity market really is only priced in about 15 to 20% likelihood of recession. Now, what does that mean? Why do I then say that? So we quite like those floating rate instruments that are pricing in the 50% chance of recession, because you can own A+ or AA minus rated instruments yielding 3.9, 4.1. So this is where you deploy your cash that's going to guarantee you a negative return. You deploy it to these areas because really only one or two things can happen. Either the recession occurs and you're getting a decent yield and you're being compensated for it already because it's in the price, or it doesn't and you get capital appreciation as well as that, 4% yield.
Yeah.
That's interesting today. In 3 months' time, it might be very different, but that's worthwhile looking at today, because the equity market is not priced in a massive probability of global recession, but there are areas of the market that have.
And is that true of Australia, Europe, and US as example, or
yes,
systematically right across the board?
In developed markets, yes. Developed markets, yes. Not so much emerging markets, but emerging markets have the extra, I would argue, an extra nuance in that China's the biggest allocation within those emerging markets, and I don't think the market's fully priced in the ramifications of the zero COVID policy. Because how do you run an economy where you've got a zero COVID policy with 1.4 billion people? Well, it's not everybody, it's in the major capital cities, but it just doesn't work, which is why we've got supply chain issues.
Yeah.
Right.
We just don't show anybody the balance sheet and then nobody knows, isn't
that just make it up.
Broadly the answer. But But mate, so maybe cash isn't trash. Maybe it's the mobilization and then where you choose to deploy that. But Dan, is the reason why markets
where is your cash? Make sure it's not trash. Like, this is the thing. You just leave it in a bank account. Well,
it's similar to what we were talking about last week, because we were talking about how the banks have longer dated fixed term rates. As opposed to the shorter date. So shorter dated fixed term rates were higher than longer term rates. It's a similar sort of concept that Dan's going, well, as the interest rates are rising and these floating rate notes, which means they're going to go up and down, right? They're going to go up and down. But at the moment, you can get a higher value, right, or a higher interest rate on them. And as it actually depreciates, or if interest rates go over time, then you can actually get the capital upkick, because as interest rates go down, if you've got them in earlier, then all other things being equal, your money actually goes up in value. Unless I've completely butchered what you said, Dan. But
No.
what I was very keen to understand is, do you reckon that the reason why the market hasn't priced in a recession, because America's actually changed the technical definition of what a recession is?
I don't think that. I think it's there's an entire generation of people sitting in the old shop like you were at investment banks in charge of quite a lot of money, that have only ever known falling interest rates and falling inflation, and that as long as there's a central bank in place that's going to backstop them, you buy the dip. So I think that's where it's come from. So we haven't seen that disorderly panic yet, right? But I would argue you have in the fixed income space. And that is the space that usually moves before the equity market does. So it's worthwhile keeping an eye on. So across those different asset classes and sub-asset classes I talked about.
Did I hear just a little bit of a too big to fail, Fenton? Andy talks about this conversation about too big to fail. If the government's behind it, or it's going to rescue it, Dan, it's not a bad place to put a little bit of your allocation, So you're saying, okay, if the government's got to rescue it, even if it gets into trouble, it's not a bad defensive play, is that?
Sort of. More that I believe there's a massive number of traders out there that think that if anything goes wrong, Federal Reserve, Jerome Powell will come to the rescue and inject capital.
Okay, yeah.
It was originally called the Greenspan put, then the Bernanke put, and now it's the Powell put, which is they'll underwrite it. They'll buy anything that's not bolted to the ground if things get too difficult. And that's kind of what this relief rally has been, in that we had a 9.1% year-on-year CPI print in the US, and then it printed 8.5. So everyone's like, okay, it's peaked. Therefore, rates aren't going to go up as much. And Powell's very quick to come on and say, no, we are still in a rate hiking cycle. 8.5 is still eye-watering. I mean, you have to go back a fair way to get to look at 8.1% inflation, especially when wages growth is not keeping up with it. It's it seems a little bit odd that people would be rallying on that, because you're a long way from that long-term target of 2, going from 9.1 down to 8.5.
But it begs the question, right? If the Fed always backs, then where does it end up?
Yeah, well, do they always back though? Because one of the things I was saying in 2021 was that I said I reckon inflation will be the great equalizer, because they won't be able to back everything whilst inflation is in above a level of comfort. Now, I genuinely think they want inflation to be higher than that 2% level. They would actually like it to be about 3 or 4 for a good decade or so to make up for the last decade.
Yeah.
But 8 is way off the charts. Yeah. Correct.
Yeah. Well, it's an interesting one too. In my neck of the woods, in relative terms, rents have actually gone down over the last decade, in comparison to what you'd expect, because the cost base with interest rates have gone down. we're actually seeing, I don't know if that's the right term, but like some sort of mean reversion where right now it's like, hey, listen, the cost base and landlords often, unfortunately, are quite lazy. They don't sort of maintain their yields as much as they should, and it's like we're seeing quite aggressive rent rises right now, but it's really just making up for 10 years of not putting the rents up because interest rates went down, it's not really that bad, folks, if you say, the last 10 years, nothing's gone up, so, yeah, it's interesting. It's interesting in that space.
Yeah, no, that's a good analogy. And you're right, as the underlying price has gone up because people could just borrow for next to nothing.
Yeah.
The issue is those that, another behavioral bias, short-termism, people that just assume that it's going to be like that forever.
Yeah,
that's the problem, right?
Yeah.
You can't assume that what occurred, in the last 6 months is going to occur in the next 6 months.
Yeah.
You do that. That's a really fast way to get burnt at some point.
Yeah. Andy and I call them good time Charlies. Like, they just they come to the party late and they think this is a great party. This will last forever.
I bought Afterpay. And I lost it when it went past it. It's like I got it, and there it is. And there it is.
And the meme stocks are the others, where you get a whole bunch of people piling into stuff that doesn't actually make any money, and you're like, well, if it doesn't make any money, how can it be worth, or it won't ever make any money, how can it be worth anything? What you're basically doing is playing something called the game of the greater fool, which is you need to find someone who's a bigger fool than you to take it off your hands for more than what you paid for it.
Yeah.
I reckon we might steal that one. I reckon that might become a common vernacular over here. The game of the greater fool. I reckon that's a cracker. But I think and I'll ask the question in a minute, Dan. Like, where's your flavour? Like where crystal ball. We won't hold you to it, but the things that you're interested in outside of the floating rate notes. But the kind of themes, and you can be as wacky and as wild as you want to be. So that's the question. But I'll kind of position it beforehand, is that what we're seeing now, and what I've learned from Jace in the property game, which is true in the stock world or in the investment world, is it's this thing called the flight to quality, right? And and in times where good time Charlies are making bets on meme stocks and riding up Afterpay, and then when it shoots back down and they've lost money on it, they were rich one day and gone the next. Once this period of time sort of finishes, which is almost like an emotional anomalous blip. Right, that if you're fast enough to be on the right side of it and get out, right, and getting out is the biggest problem, because most people fall in love with that made them rich and famous, or made them a 20% return, so they don't sell out, which means that then they're negative 10 as it's fallen 35%. You do the math, Dan. You're better than me on that. But ultimately, what we're seeing now is the flight to quality. What I can gather in real estate, in resi side of the equation. But I won't comment to that because that's Jace. But certainly we're seeing, where I say cash is king, I say, but it's from a different perspective. It's cash flow is king, in that good cash flows, strong cash flows, providing operations, good stuff that's going to keep going no matter what happens. All of a sudden, this not very fancy, but very boring, pragmatic, just stuff that's just going to keep making money, all of a sudden starts to kick in. And so you have the emotional up and down. And then when you get to periods like now, it's the flight to quality, which means that good position in property or whatever, I'm not going to comment, I'm going to screw it up, Jace, but in stock world, it's companies that are positioned well in the right sectors that have great forward-looking cash flows. They will profit. And those sectors, like the Australia mining resources sort of sector, has propped the Australian economy up a bit of recent times as well, and got us through the last GFC. That held us up. That sector those companies had great forward income booked well in advance. So it was that flight to quality. So, mate, while I've given my little maybe uneducated preamble to it, mate, what are the things that you like as loose or as radical or as pragmatical as you want to be? What do you like?
Yeah, at the moment, you don't need to be loose or radical, I don't think. Probably the most out there thing that we like, which isn't out there at all, I don't think anyone would argue that this is a bad idea, is soft commodities, is agricultural stocks. And reason being is that if you look at the price of them, they're not ridiculously expensive. So I if you don't mind, Andy, I wouldn't mind putting a caveat to that flight to quality component.
Totally.
Normally when things go bad, people will, flood to the quality end of the spectrum, whether it be property or it's AAA rated bonds or it's businesses with really predictable earnings, etc. The caveat that I've been saying for quite a while now is, yeah, but how much do you pay for it? Because there are a lot of managers that I've spoken to, and I'll just use equities as an example, who say, yeah, but people will pay they'll pay any price for quality. I'm like, well, no, actually they won't. If you're a student of history, go back to the 60s, and there was a basket of stocks called the Nifty 50. These days, the Nifty 50 is an index in India. But back in the 60s, it was an index of the biggest names in the world: Procter & Gamble, McDonald's, Coca-Cola, you name the big things back then. And that's what sell-side brokers were selling to their clients, and they overpaid for them. And those businesses, the majority of them were fantastic businesses that continued being profitable, but you overpaid for them. So it took a long time to get your money back. In many circumstances, you were down 80%. You had to stick around for decades. And the modern day equivalent is something like Microsoft. If you bought it in 2000, you didn't make your money back until 2016, and yet it increased its profitability the entire time. There was nothing wrong with the business. It was a great business. You just paid too much for it. So that's why I come back to this price argument, that the price is the greatest dictator of what your long-term return will be. Because you can even buy, if something's not really worth a whole lot, but you pick it up for next to nothing, well, you can still make some profit out of that too. That can be a way to invest. Now, I think that there's going to be an opportunity to invest back into that quality end of the spectrum, Andy. But at the start of this year, I was arguing that it was too expensive because it had run so hard.
Yeah.
But there'll be another bite of the cherry at some point in the future. It's all about being patient, right? This is not a short-term. This is not a short-term trading game.
No, I love that. I absolutely love that. And thank you for correcting me, because I reckon that's probably the best simplistically articulated version of if the P is outrageous, then the E doesn't matter. And what I mean by that, there's a thing that you'll hear in markets, you hear maybe your financial advisor talk about it, investment managers talk about it all the time. It's price to earnings. And Jason and I talk about it in simple terms in business all the time. If the P is too high, then the E doesn't matter, which means the price is too high, then it doesn't matter how much it's earning. So the P is always got to be relative. The price has always got to be relative to the future earning potential. And Correct. So to summarize, the flight to quality doesn't just mean, all right, everyone should just go into buying General Electric because it's got a great income stream, or the banks because they've got great forward-looking income streams. It's a matter of, yes, but at the right price.
Correct.
Yeah.
That's exactly right.
It's the same gig actually right now for literally the last 6 months, or probably it turned in November last year in the real estate game, where the market, for decent stuff, overpriced drastically, and we changed a few gears in our mechanism as well. So and I think there's a little bit further complications in the world of real estate right now with the pricing of materials and deliverables, in my game. So it brings a few dimensions to it. But no matter which way you slice that, some properties, which Andy, you and I have chatted about endlessly, like, wow, you'd want a piece of that location every day of the week. And I'm like, well, not at 200 grand more than it was, 6 months ago. Nah. Well, we'll just leave that alone for another year or two, and I reckon we'll get it for a better price.
Yeah. And it's not an accident that you see the same thing in residential property as you do. I'm talking about equity markets, but the flight to quality could be to AAA rated bonds, which we've seen previously. It's because it's people and systems. And irrespective of the market, everybody's susceptible to these common biases that we have.
Yeah.
Right?
So it's the flight
being
to
aware of the start.
Yeah.
the flight to it, but and that's where they go. I love it. It should be the but index, I reckon. I reckon, Dan, you could be the creator of the but index.
Well, we've got the rogue, the renegade, and the but. I think that'd be
mate. That's it. I reckon we would be. We'd do amazing. Can you imagine it? And today on Bloomberg, ladies and gentlemen, the but index is up 28, and that's after a 285 basis point rise the day before. But all doesn't seem to be shiny on the horizon. I reckon that's an absolute bloody cracker. And I think we should all be looking for the buts a little bit deeper, and maybe asking that but question. A little bit more in regards to our advisors and just when we're
our own theses.
Yeah.
You want to question your own theses all the time.
Yeah.
Right. If you don't understand the other side of the argument, then you don't even understand yours, really.
Totally. Yeah. Yeah. Benton, mind blown.
Mate, I reckon that could be used in domestic arguments around the world tonight.
Don't start that, Benton. We'll be out of control.
The divorce index just went up 100 basis points. Jesus, that's gold.
That is gold. Well, gents, I've got to do a but for both of you because I have a date with my the love of my life, and look, she's already put it in the chat. Look at this.
We can argue.
She's on me. We can argue that over dinner. Because the reason we're out and about is 30 years we've known each other. And this is
that's amazing.
30-year weekend away, and we're going to go up to dinner. So I got to zhuzh myself up, fellas. I'm not appropriately attired for the love of my life right now, so I need a moment or two.
Jason's got to go and don on a tux, and mate. Well, I'm sure it'll be amazing, whatever it is that you've got planned. Hopefully, majorly spectacular. It doesn't really need to be. It just needs to be the two of you in a loving atmosphere, mate. But congratulations!
We're looking the Brisbane City and the Brisbane River tonight, and it's going to be lovely. So, no hoodie. I've got instructions how to dress. No hoodie. And no t-shirts, okay?
Yeah. and Shay is now dubbed the patron saint of patience. Mate, mate, always good to catch up with you, Jace. Dan, mate, thanks for coming on. It won't be the last time. I hope. I know that you'd had a bit of disturbance in sleep, and you were fighting to be here today, and we really, really appreciate it, mate. It's these sort of insights, and like I said, your mind is quite amazing, and I think maybe we should throw some of the residential real estate statistics at you and see what you make of those things. I think that would be amazing.
Oh, no, I'd love it. I'm mad keen to pick your brain on that one, Dan. I'd love you to shoot holes in my positions, because that's one of the things I loved about hanging out with Andy, because I'm like somebody tell me why my opinion is flawed, because because I want to know
and that's definitely my biggest takeaway from today, because quite often in my world, Dan and Jace, when something feels uncomfortable, I say it's the right thing to do.
Yeah.
And what you just articulated there, which was it was a nuclear bomb that went off in my brain, was if you don't understand the other side of the argument, then you don't understand the argument, or you don't. And it is so true. And I think that if there's one nugget that everyone should take away from that, is that understand the other side of the argument, and if you do, then maybe, just maybe, you understand the game that you're playing.
Yep.
Correct.
Nice articulation, Benton. Well, gents, fantastic to hang out with both of you as always, Fenton. Nice to hang with you, my friend. And Dan, mate, I hope we could make this a regular thing, and maybe we do it in the flesh one day when we're down. Where are you hail from anyway? You're a Melbourneite or where?
Me, I'm in the Snowy Mountains. My business is in Sydney, but I moved to the Snowy Mountains. So I live in Jindabyne.
I love it. I live in the Gold Coast and my business runs out of Melbourne. So there you go.
I reckon the reason why both of you have successful businesses is something linked to the proximity of you and your ideas to the people who are behind the actual running of the businesses.
Yeah, there's some distance between our
Yeah, I can't argue against that. I think you're onto something, Andy. It's well, from my point of view, yeah.
Mate, genius, excitement, and great ideas, mate. They're the future, but sometimes they can be very disruptive for the people around us. But mate, thank you for joining us. I really do appreciate it.
More than welcome.
Case does. Thank you, ladies and gents, for joining us. Everyone, drop in the chat, say happy 30th anniversary to Jason and Shay, and mate, may you guys enjoy an incredible, loving evening together. And for now, it's good night from me.
And it's a good night from him, folks.
Good night, guys. Have a great weekend.
Thanks, Dan.